world is changing fast. New technologies are impacting how we think about products, services, and the way we live our lives. Nowhere is this trend more present than in financial services, where new business models and customer expectations are changing our conceptions about banking, finance, and the very nature of money. Welcome to Rebank, a visionary podcast about banking, fintech, and the future. The future of banking is here. Hello and welcome to Rebank. I'm your host, Will Beeson. Today we're thrilled to welcome Virraj Jatania to the show. Virraj is the founder of Pockit, a UK-based neobank looking to solve the problem of financial exclusion throughout the UK. Despite the UK's status as an advanced economy, the country still has millions of unbanked people completely excluded from traditional financial services. These individuals rely on expensive solutions like check cashing centers, pawn shops, and payday lenders to meet their financial needs. Virraj and Pockit are building a solution for these individuals, granting them access to transaction accounts, payment cards, and a range of other financial services products. We've discussed financial inclusion at a high level a handful of times before on the podcast, but it's great to finally sit down with someone who not only knows it inside and out, but works in it on a daily basis. Pockit's doing great work in the UK, and it's clear how the model could scale to other countries as well. Tweet at us at Rebank Podcast or at me, your host, at Will_Beeson. If you like the show, please subscribe on iTunes, leave us a review. It's hugely helpful. As always, thanks so much for tuning in. We've got some new, exciting things planned for 2017. Please welcome Virraj Jatania. Virraj, welcome to Rebank. Thanks for joining us today.
Thanks for having me. Good to be here.
So let's dive right in. Tell us about Pockit.
Sure. So we founded Pockit with the mission to build the world's most inclusive bank. And what that means is delivering end-to-end banking services to the most underserved and unbanked consumers in society. We start off with our most sort of basic product, which is a current account that customers can have salary, government benefits paid into, or we also give them 28,000 locations across the UK. They can deposit cash into our accounts. We allow them to make payments from our accounts, so pay bills, transfer money to other people. And then we also give them a debit card so they can transact both online and on the high street, and an app from which they can manage their money. So that's the most basic part of our service, and it's now starting to grow into a whole number of different verticals in financial services. So hence sort of referring to banking services, we know that our customers are very underserved across the whole spectrum of financial services. So we are really trying to now build out across multiple verticals, including remittances, lending, insurance products, savings products, and the list kind of goes on.
So are any of those products live already?
So we are very close to releasing our remittance product, which will probably be in Jan or very, very latest in Feb. So that's sort of keeping us very busy at the moment, and then we'll probably be into lending in Q2. So the kind of product development roadmap is pretty packed at the moment and moving at quite a pace, which is exciting.
Ah, that's great. Will it be kind of consumer unsecured lending for the most part? Yeah,
so consumer lending for sure, and quite focused on a overdraft type product. So because our customers, as I referred to, are sort of in the kind of low income demographic, their needs are not really for payday loans or for longer term loans. They need actually just more of a small flexibility. So we're not looking at sort of doing bank style overdrafts where it's sort of a couple of £1,000 or anything like that. It's actually more micro. So anything from £50 to £200, and giving them the flexibility to kind of move within that amount on their account, so that if there's an unexpected event in their life, they have the flexibility from Pockit to get through that situation. We obviously have quite a bit of data on our customers now. A large number of our customers have their salaries paid into our account, so we have, we know who they're employed by. We have access to a whole variety of data that gives us a lot of indication about their creditworthiness. So customers have been asking it for a long time, and so it's something we had to make sure we deliver. So we're hopeful that in early to mid Q2 that will be a product launch for us.
Mm-hmm. Great. Well, look forward to that.
Thanks.
For whatever reason, the term neobank is often used to describe digital propositions like Pockit that kind of replicate bank functionality without actually having banking licenses. There are a number of similar propositions in the UK, including Revolut, Monese, Loot, GoHenry, which each kind of seem to focus on specific customer segments. Similarly, I guess there are a couple neobanks, again, if we can use that term, out of the US, some of the kind of the original movers in that space, Moven and Simple. It sounds like Pockit is different from any of those propositions precisely because of your focus.
Yeah, so for sure. I mean, it's a big part of our differentiation is really around the target market that we focus on, and really understanding that market inside out and building a product that is right for those consumers. So we've been very heavily focused in that area. I think in addition to the customer focus, I think in the product vision is also quite different as a result as well, in terms of us versus a number of the other players. So I think some of the neobanks, if you want to use that phrase, will focus on providing data analytics back to their customers and smart alerts and things like that. And that's not actually that important for our customers. Our customers we're typically the first financial product that a customer will interact with. So it's all about simplicity, convenience, transparency. And that has to go right through our entire product. So not only what we choose to build, but also the way we build it. So I think there is I think the large number of the neobanks are very focused on sort of millennials and solving a problem for them. And that has a very different set of requirements. Whereas for our customers, it's really about, giving them the kind of core products and core functionality that they need access to. So I think that's quite a big difference for us.
Mm-hmm. I've heard you talk in the past. You made a comment around how meeting the needs of the unbanked, of the financially poor, was often very different than the way that traditional banks or traditional banking product consumers might expect it to be, i.e. that the needs of those customers was often fundamentally different than the needs of middle class income earners.
For sure. And the interesting thing is the product set is different in terms of, at the most basic level, obviously everyone needs a current account, everyone needs a way to pay bills, that goes without saying. And so from that specific area, the product is the same for a low income consumer or a middle income consumer or a high income consumer for that matter. But where it starts to become quite different is as you start going into different products and services, and also where the other area becomes quite different is the way you build that proposition. So I'll give you an example. When we did a huge amount of testing and research with our customers and our target customers around how we should price the product, and the kind of resounding feedback that we got was, we understand we have to pay. We know nothing comes free. Every other financial product or type of product that we've interacted with, we get screwed over and we get charged a lot of fees. So there's no problem about paying, but we want it to be simple. We don't understand percentages. We don't understand monthly fees. We don't understand admin charges or anything that's kind of remotely not transparent or opaque or not clear. And that's very different to, if I think about myself as a, sort of a middle class consumer, we're very happy and to take on a percentage charging structure for something. Or
well, interesting. Presumably it's because we're used to it and there's no alternative. I'm sure most of us would be very happy to pay, fixed fee, similarly transparent pricing to what you're talking about.
Yeah, exactly. I mean, I think you're right, and I think we're just used to it, and that's just been the status quo. And and also we've all got a level of financial literacy and understanding where we know what we're getting ourselves into in most cases. So I think that's a really important thing to understand, and we really put that at the heart of everything that we do, to make sure that we are always keeping things really, really simple and servicing these customers in a way that they need to be serviced. So yes, it does require a very different way of thinking, and it's important to I talk a lot to the team about this, is always kind of putting ourselves into the position of one of our customers, or picking up the phone and calling a customer and asking them, how do you think we should do this? And that's a really important part about what we do.
We've discussed financial inclusion a few times on the show previously, usually in the context of emerging markets. Talk to us a bit about financial inclusion in developed markets. I mean, what's the situation in the UK?
Yeah, sure. So it was. It's extremely interesting because it was when I first read the statistics, I couldn't actually quite believe it. I come from a family business background. We did a lot of our business in emerging markets. So growing up, I lived in India, Russia, the Middle East, a whole bunch of interesting places. And there you really see everywhere. You see the reliance on cash, and financial exclusion is a huge problem in those markets. And that's kind of what piqued my interest in this whole area. But as I started to look at the numbers, it's crazy, and especially in developed markets. So Europe has about 100 million people who are financially excluded, or underserved.
Which is like a third of the population.
Yeah, which is about 25% of the population. And then the UK has about 6 to 7 million people who fall into this bracket. And being financially excluded is not just having no bank account. It's also not having access to other financial services. So not being able to access insurance, not being able to access lending products that are right for you, or savings products as well. So it's got quite a broad category. And it's typically what we see is there's normally 3 to 4 reasons why people become financially excluded. So one is that they have been in debt or had some kind of major issues when it comes to lending. And that has meant that the bank has said, okay, you clearly don't know how to handle your money, and we're taking away your account, or we're not going to provide you these services anymore. And they take that away from them. The second is around being new to the country. So someone who's a migrant who comes into the country, or has not lived in the UK for a long time, has a lot of trouble opening an account because they don't have enough of a track record. The third is sort of around quite selective choice by banks. So I mean, I was with a bank recently, and I won't mention names, who said, we do choose to sometimes turn down customers, and it's based on an assessment of how profitable that customer is going to be. So there's almost a sort of a choosing process where if during an application process a customer doesn't look like they're going to be that profitable, they will be declined for a number of different reasons. And then the fourth is around lack of consistent documentation. So the number of times we come across customers who say, I don't have a driving license because I can't afford a car, I don't have a passport because I don't travel. Documents is actually quite a big issue. And banks don't really have the setup where their KYC processes are agile enough to be able to onboard a customer in the way that we might. So those are sort of typically the reasons that we see it happen. And in the UK, you still have 4.5 million people paid in cash every year. So despite what everyone thinks, we're still a very heavy cash driven economy. And there's a much bigger problem than anyone actually really chooses to pay attention to.
Well, it sounds like a phenomenal opportunity. How long have you guys been live with your prepaid card and transaction account?
Yeah, so we've been live for about 2 years, just over 2 years. So September 2014 is when we launched with our first customer.
Mm-hmm. And how's what does customer growth look like since then?
So it's been pretty good. We're at about 123,000 customers now as of today. So we've grown quite a bit. A lot of the growth has really happened in the last year. So we've probably grown about three times in the last year, which has been so it's been pretty good. And we're kind of continuing to see the growth going in the same direction. So we hope to double again, or get to about 300,000 customers by the end of next year.
Right. You mentioned that remittances is the next product that you guys are bringing on, which would suggest that there's a kind of an international element to your customer base. Is there a specific, ethnic breakdown that's relevant to discuss amongst your customer base or this segment of the market more broadly?
Yeah, so what's quite interesting is actually only about 35% of our base is a migrant background. So actually the majority is actually low income UK nationals, but the 35% is still quite a decent proportion. So we felt that it was one of the most vocal product requests we were getting from customers, where a lot of people were saying to us, look, I have my salary paid into my Pockit account. I then have to take cash out of an ATM and then go to the Western Union and go and transfer money through Western Union. And that whole process just sounded so inefficient that we felt compelled to solve that problem for our customers. In terms of the breakdown, we actually see it's quite vast. It's not one specific country that we see a lot of people coming from. So we have from everywhere in the sort of typical expectations of Eastern Europe to African countries, to Southeast Asian countries, to South America, and even North America as well. So we actually have a very wide spread. I think our biggest migrant population only accounts for about 3% of the 35%. So it's quite there's quite a big long tail in there.
Well, had I known about Pockit when I moved here about 2 years ago, I'm sure I would have opened an account. It took me the better part of 2 months to open a bank account. So I totally feel that pain. So it sounds like at the moment Pockit is UK only. Certainly sounds like, given the scope, the breadth of the global financial inclusion or exclusion, to use your terminology, issue, that longer term international growth prospects would be on Pockit's radar screen.
Yeah, for sure. So today we are UK only. So all our customers are UK based, and we think there's a massive international opportunity. There are a number of countries where this problem is obviously much bigger than in the UK, both developed and emerging markets. So we definitely see international as a very exciting opportunity for us. I think I guess the one thing I would add to that is, I think scaling a fintech business internationally is a completely different undertaking to scaling other types of tech businesses. The amount of effort you have to put into AML and compliance and KYC processes and really understanding local regulation is so important that I think you got to be careful to not rush too quickly into an international market. There's a huge market on our doorstep, and we're focused on making sure we own the UK market, and then we think international should definitely be on the agenda. So we're looking sort of at an 18-month time frame before we go into an international market.
Mm-hmm. I'm just kind of thinking through the almost this natural conflict, natural tension between the business that seeks to deliver social good, to solve a social problem, and the kind of traditional concept of a for-profit corporation, which looks to do whatever it needs to do to maximize shareholder interest. How do you think about that? I mean, presumably part of it's having investors who are wedded to the fundamental value proposition of Pockit. But how do you think about that?
Yeah, I mean, I think the tension is only really there if you're either complete charity or exploitative. That's where it gets really difficult, because if you're a charity, then your investors are never going to see any return. And if you're exploitative, you're reputationally damaging, and there are a lot of problems that come with that. I think when you are very transparent, very fair, and sort of built in the way that we have built the business, the tension's actually not too extreme. So we know that we are solving a huge problem, and that allows us to meet our social aspirations. We know we're able to charge a set of fees to customers because they understand it and they are willing to pay for it, so we can meet the profitability requirements that the investors have. And an interesting example to talk around this is a number of customers who we serve before they take up our product would typically be, say they're working in temporary labor. One of the issues in sort of temporary labor, blue collar labor, is people will get paid in a sort of a generic check, and they take the check into cash checking services like the Money Shop or Cash Converters, places like that, and they'll pay 10 to 15% to convert that check into some cash. So someone who gets paid £400 a week ends up with £60 being taken away from them. That's exploitative, right? And obviously really unfair. Those types of consumers will now have their salaries paid into our account totally free, and then there will be some small charges as they go along and use the product. And that just shows how you can kind of have the best of both worlds, because you solve a problem and you bring someone right into the system and you give them access to transacting online, paying bills, direct debits, all those kinds of things. And then you are also able to build a profitable business. I think we've managed to deal with that fairly easily so far. And I think the other thing is that we're building a long-term business here. So our investors share our long-term vision and what we're trying to build and the problem we're trying to solve. And I think we're in a world we're in a direction where we get a solution on both sides. So we solve problems for our customers and we give them the products they need access to, and we also can make a bit of money.
As a fintech entrepreneur in London, you're living the dream. How did you go about designing, building, launching, and now scaling a startup? What were the early days like?
Yeah, so it's interesting. Being a fintech entrepreneur or any kind of entrepreneur, it's quite a challenging task. You're definitely not taking the easy route or the easy path, and you have lots of challenges every day. I think you go through as many or probably more bad days than you go through good days, but it's the desire to deliver your vision that kind of keeps you going and keeps you pumped. As I said, the inspiration sort of came out of a number of personal experiences to build the business. And actually in the early days, we were a very small team, probably 4 or 5 people. And interestingly, I used a lot of outsourced partners to build the original product. And when we went into beta, and that was one of my biggest regrets. If I was going to go start my next business, I definitely wouldn't do it that way. But it taught me a lot, and it taught me really to kind of be much better at product speccing and how to go about building new products and thinking about how we kind of take the business forward now. But what it allowed us to do was get something off the ground quickly and efficiently, and it allowed us therefore to gather data and understand the problem that customers were facing. And so when we really understood that, and we spent a lot of time sitting with customers and hearing their stories and how they interacted with the product, and all the product feedback was bad, but what was very clear was that there was a major problem and no one was trying to solve their problem. And so for that, I'm quite grateful. And and then obviously learning the mistake of not rebuilding it in the best way was also useful, because when we then built the full product, which we launched in September 2014, I made sure we did it the right way, and I started to hire my team and get a really good, strong group of people into the business and build most of it in-house, which was really important. And that building phase, when we went from out of beta to building for the full product, took us about 8 months, and it was an extremely, I would say, it was quite a frustrating time, because you knew that there was a big problem to solve, but inevitably, and especially with financial services, you can't build a pure MVP. You can't get up and running in a few weeks or a month. It takes time, and you need to make sure that the product does the basic things it needs to do, because at the end of the day, you're dealing with people's money. So we had to make sure that we did that process properly, and because we were working with other external partners, you had a number of approval processes to jump through and hoops to jump through and boxes to tick. So that building phase was quite frustrating, but we finally got there, and I remember being very excited the day we launched. And then what hits you is that you're now an operating business. And that is very different to a business that's in build mode, because all of a sudden you now have customers' money coming in, you've got people transacting, you've got people trying to attack your system fraudulently, you've got a whole bunch of things that you just never really thought would start happening. And that's where it gets, I think, really exciting, because you then go into the nitty gritty of like running a business. And so I remember again in the early days, we did things manually. We were very scrappy. We would we were very, very, the whole team, and still today is very, very hard working. We had lots of late nights to make sure everything ran smoothly, all the processes were good, and it was great fun. And then you realize, as you kind of go into the scale up mode, that way of running the business for a few thousand customers is not really sustainable as you get bigger and bigger. And so I think the really important thing is that you have to kind of realize, as you're scaling up, that you do need to build in real strong and really sustainable processes and ways of doing things. And you've got to figure out what should be automated, what can still be done with people. You've got to think properly about customer services. You've got to think properly about compliance and fraud and all these types of things. So it's been a very interesting journey, and then that all happening in the space of sort of 18 months is doesn't really allow you to kind of get used to any one situation. And I think that's where having amazing people really comes into it, because you as an individual can't do everything, but hiring well and bringing in good people who are passionate about the business and who are who've got good experience is crucial. So it was so early days were very scrappy is probably how I'd put it, but great fun. And now it's a little bit more organized, but still a lot of fun, which is good.
So you mentioned that team of 4 or 5 initially. And were those co-founders, were those paid employees?
Yeah, so actually they were all paid employees. I'm effectively a sole founder. I mean, for the record, I kind of co-founded the business with my father and my brother, but they're not involved in the business. But it's so actually only a couple of those original team are actually still in the team today. But they were very crucial at that point in time, having the right people to execute on what we needed to do.
And when did you first raise external financing?
So we first raised external funding in 2014, and that was a sort of a £1.5 million round of.
And that was how long after you had started?
We got up and running in beta in 2013. So we had the beta data and proof points, or very early proof points. So we probably had about 9 months of real kind of something to show for. So it wasn't pure concept. So we seed funded as a family. My family seed funded it. And then once we had enough data, we went out and raised external money. And so that was a £1.5 million round at that point in time.
And you've raised more capital since then?
Yeah, we've raised more capital since then. So we've raised about another 5.5 million on top of that as well. So, and that was sort of closed off about a year ago. So, so it's been exciting.
Well, of course I have to ask, and I'm going to show my ignorance when it comes to soccer, but Alex Ferguson is an investor of yours, right? He's a former coach of Manchester United.
Yes, that's right. So he's probably one of the best manager in the world, and or a former manager in the world, and sort of a footballing god, I would say.
And how'd that a connection come?
Yeah, so we were introduced by a mutual friend a number of years ago. probably actually a bit before we got up and running. But as I sort of started to tell him about what we were building, he was very interested and excited by it, and we were very lucky to be able to welcome him as an investor.
Well, that's great. And you mentioned it before. It sounds like your investor base is very much aligned with your longer term vision and the social impact you're looking to make.
Yeah, they are. And we have a mix of, we have a fund, we have a number of family offices, and then sort of ultra high net worth individuals as investors. And they're all very supportive of it. But I think, what's important is that they recognize that you can solve a major social issue and be profitable, and it's quite clear to see that. And one of the things that I always find quite interesting is that if you look at sort of the millennial consumer group, you can't actually charge anything for products to those consumers, or at least at the most basic banking services level. So depositing money or taking cash out of an ATM or paying a bill and things like that. So actually that group is sort of really hard to monetize. And so there you're having no social impact and also very difficult to monetize. And then with our customer group, you're having a big social impact and you can also monetize. So I think investors have been very supportive actually. And I think, the more and more investors we speak to, they actually love the fact that you are able to solve a major problem, which is something really nice to talk about, and also do it in a way where you're not going through sort of negative unit economics, which is quite important.
Well, you're in a lucky position being able to effectively charge for transaction banking, what's given away as quote unquote free banking, free current accounts in the UK, which are, I think, I forget the statistics, but something like close to half of customers end up paying for their current accounts via fees and charges, and what it does do is certainly crimp competition. New banks, new propositions have a tough time coming to market if the broader customer base is expecting to pay nothing for great service. Interesting conundrum. Yeah,
for sure. I mean, I think the whole notion of in credit free banking it's a bit of a myth, to be honest. I mean, the reality is that there is a cost to provide those services, and at the moment banks kind of take on that cost because they're able to then upsell other products, and they have big ownership of the infrastructure where their costs are quite minimal. But if you're a new entrant, as you're referring to, you don't get the benefit of a lot of those things, and you don't also have the history of being around for hundreds of years or whatever, or however many years these number of these banks have been around. So you do get into quite a sticky position where effectively you're, if you're servicing that sort of a similar clientele to the main high street banks, you've got to compete with their product offerings, and their product offerings are completely free. So if you're in that position, it is pretty tricky.
How is Pockit built? What are the component parts, and how'd you go about designing and building them?
Yeah, sure. So we decided to build the business on the back of an e-money license, which is very different to a banking license. You can still deliver a lot of the same product set, but there are certain restrictions. A lot of the restrictions around things like, you can't use your customer deposits to lend out. You are restricted in terms of how much people can deposit with you. So it's not as generous as a bank would be. But given our target customer, we didn't really feel that was an issue. And, we felt that being able to get the product up and running quicker and be much more capital efficient was a bigger advantage. And then the third major difference is that you're not covered by the financial services compensation scheme, where if the bank was to go under, or if Pockit was to go under, that the funds are insured for up to, I think it's just moved up to £85,000 recently. It was £75,000. So that was the first major decision we took from an infrastructure perspective, was to use an e-money license. And then the rest of the component parts consist of a few sort of key players in our supply chain that kind of allow us to deliver the product. So we have a banking relationship with Barclays, who provide us our sort code functionality so that we can give customers a sort code and then issue bank account numbers off the back of that. We also use
access to payment schemes.
Yeah, and access to payment schemes then through them, and they're the clearing bank. And then we also have all our funds sitting with Barclays as well. So they also are a custodian for all customer funds. And then we've partnered with Wirecard. So Wirecard are effectively the provider of the e-money license, and we effectively sub-license that from them. And they also provide us the settlement services to MasterCard. And, it's actually much more cost efficient, again, to be doing that with a partner, because they are doing quite large volumes of settlement. You get access to the best rates and costs per transaction. So there's sort of you do give up some control, but the benefits you get out of it are quite strong. And then we have a transaction processor, which is a company called Global Processing Services, and they basically are the point that processes the physical transaction when someone goes and puts their card into an ATM machine or a chip and pin machine. And that sort of broadly covers our kind of core partners, who we then integrate into, and then we own pretty much everything else in the stack. So how we transaction monitor, fraud monitoring, obviously onboarding of customers, their whole account management, the ability to move funds, do all those kinds of things. All those processes are managed entirely by us.
And you've developed all those yourself?
Yeah, we've developed all of those ourselves. So we have a team of 10 in-house in our London office developers, and we've now started to actually build out our team in Poland. We are finding it extremely difficult to scale up quickly on the engineering side in London. It's extremely competitive. And more than the competition, it's just the time that it takes. So we've found that typically to get a really good engineer, you're looking at a 2 to 3 month process, including the notice period. So we just don't have that kind of time. So we needed to find another option.
For the remittance product that you mentioned before, is that effectively via your agency bank to Swift? Is it different?
Yeah. So we're on the remittances side, we are partnering with a payment service provider who sits in the middle. So effectively, we will actually pass our customers' funds to them, and they will then take care of the actual settling into the various international bank accounts. So they have the relationships in all those countries, and they fulfill that process. We think in this scenario, partnering is better than us going and opening a bank account in Romania, Poland, Slovakia, Latvia, every single one of these countries that we're going to have to send money to. So we're using a partner for that. But again, the rest of the process is all done by us. So we will do one transfer effectively to them every day, and they'll carry out the remitting of all the remittances of those funds to the respective correspondent bank accounts.
And similarly, in terms of the credit product that you mentioned, you might start offering down the road.
Yeah.
How would that be structured?
So again, we are probably going to do it initially through partnership. And then once we are comfortable that we can manage that process ourselves, longer term, we might decide to bring that in-house and do it ourselves.
And that would be via raising third-party investment to then lend if you can't lend out the deposits that you...
Yes,
take?
exactly. So for us, we would need to raise additional capital onto our balance sheet, probably debt capital, which we could then lend out. And that's why we want to build a bit of a track record through a partnership first. So we really understand it. We have good data to back up our customers, the default rates and how they pay back and all those important metrics, and then choose to bring it in-house if we feel comfortable at that point. That's the most likely route that we'll go down.
That's interesting. It definitely suggests that with the right structure, there's virtually no bank equivalent product that you can't offer.
Yeah, exactly. So I think with the right, as you say, with the right structure and the right partners, it's very durable. So you can pretty much offer most of the products you'd want to offer. Your margins may not be as great, or you might be giving some away, or you might be sharing some revenue. But yeah, our view is that getting out to market and actually solving the problems of our customers is more important than owning all of the stack today. We do feel that at some points it will, in the future, it will make sense for us to own various parts of our stack, and we'll make those decisions as we scale up. But we feel, while we're in that scale up mode, it makes sense to do it through partnership.
It's actually a nice transition to my next question. I think one of the things that most people ask themselves when thinking about quote unquote neobanks is what's the revenue model and how sustainable is it? The need for a solution like Pockit in the market is undeniable, but it hasn't traditionally existed, in part, I think it was reason number 4 that you mentioned before, because often those customers aren't profitable to traditional incumbent banks. So how is Pockit able to service those customers in a profitable and sustainable way?
Yeah, so I think there is therefore a reason why we have the charges. So there's a cost of providing each item that we provide to customers. So every time a customer uses an ATM machine, every time a customer deposits cash, every time they pay a bill, whatever it might be, there are always costs associated with those transactions. And because we're not currently making money off lending or other products like a bank might, we feel that it's important that we, in a fair and transparent way, share those or pass those charges on to our customers. We touched on this a little bit before, but the customer segment that we service are very understanding of that and very aware of that, and actually love us for our transparency and simplicity when it comes to charging. So I think if you're not charging, you're funding it, and that's it's pretty binary. Those are the two options. The costs are there and they exist, and either you choose on some occasions to take it on yourself, and in other occasions you decide to charge for it. So we pretty much charge for most of the services where we incur costs. There are some where we incur costs where we won't charge, but that's a sort of that's a decision that we have to make and choose when is it right to charge for something and when is it not.
Well, that absolutely sounds like the right strategy. I mean, having kind of upfront, transparent pricing, being open with that amongst your customer base totally seems to make sense.
Yeah, I think it makes sense, and I think customers understand it and they actually appreciate it because they know they're not going to land up with some kind of hidden charge somewhere down the line. And I think the cost of the banking infrastructure, even if you own more of the stack than we do, are high. Only now people are just getting access to things like faster payments, and even then, if you want access to faster payments, the cost is still pretty substantial until you're doing a large volume of transactions. So there are extremely high costs, and if you want to provide those services to customers, as I say, either you have to choose to fund it or you do it in the way that we do it, and we pass on some of the charges to customers. So I think that's the way neobanks, or whatever we want to call them, digital challenger banks, are going to have to operate. They will, and I think you're seeing different models today. You're seeing some people who are funding it. You're seeing some people who are doing monthly charges, and then you're seeing some people like us who do a kind of a per transaction or sort of almost a pay-as-you-go type charging structure. And I think it really depends on, one, I guess, obviously how much funding you have. If you can keep funding it, is one thing. I think the other is what your customers understand and what they're willing to pay for. I think those are the sort of the bits that will define how you go about doing that or undertaking that process with customers.
Mm-hmm. I mean, it's interesting to think about some of the, including like some of the quote unquote neobanks that I mentioned before, potentially targeting different customer segments. As you mentioned, some of those companies fund a lot of these fees. So they're offering free international transfers or free international ATM withdrawals. Customers, presumably across categories, appreciate that those transactions have a cost to the bank, and therefore, at some point, the shoe's going to drop, right? I mean, these transactions won't be free forever.
Our view on it is that you can't keep these free forever. It's very, very tricky, and at some point the pressure will come in, and these companies will have to say, okay, we're going to have to add a fee, and we've already started to see it happen. I mean, I have great respect for our peers, but you've seen it with things like Number 26 closing a number of accounts because of high ATM withdrawals and therefore very high costs back to them. I think you've seen it with Revolut, who have brought down the limits on how many free cash withdrawals you can have. So you're starting to see those pressures kick in, and that means that you can't offer these services totally free. So I think the reality is that you will start seeing charges come into it, and I think it's really the only way to go about doing it. And another example, I think Atom have done a great job, but if you look at the product set that they've gone with now, SME loans and mortgages, those are high revenue and profitability products, and they've chosen to go down that route as opposed to going down the route of providing day-to-day banking products and functionality, because they know they're not going to be able to charge big numbers for those and pay back on all the investment that they've raised. So I think you're seeing those types of decisions and those types of pressures come into play across the neobank or digital challenger bank space, and I think it will continue.
I mean, I guess one of the questions for an entrepreneur like yourself, or indeed your peers, is how much of that dynamic pricing policy, i.e. revising what price schedules do or don't look like over time, once you're live, once customers are used to paying certain things for certain transactions, or indeed not paying for certain transactions, how easy it is to change pricing over time, and how potentially preferable it might be to be upfront transparent about pricing, charge a fair amount, signal it to your customers immediately, and move forward that way.
We're really in this world where like simplicity is so important to everything that we do, that we really want to try and keep it as simple as we possibly can. So I think it is tricky, and I think changing that all the time is hard to keep up with.
Well, you mentioned the importance of simplicity. I think simplicity equals trust in a lot of cases, in business, in customer relationships with service providers. I think that's particularly true in banking. So
yeah,
totally makes sense.
Yeah,
I think the business model that I could see working from the likes of some of the neobanks is a free banking plus marketplace model, where you're effectively earning referral fees for referring third-party products to your customer base, and you're perhaps negotiating effectively cheaper rates with those third-party providers in exchange for volume. You're passing some degree of savings along to customers, but earning a referral fee, and therefore you're able to effectively subsidize that free transaction banking.
Yeah, for sure. And I think that is the way the model has to work. I think even if I look at our own business, we see the real margin and the real kicker will come from the additional products and services that you provide, and a lot of that is about partnering up with a company where you get good economics, so that the margin becomes big enough to make it interesting for you as a company. I think the important thing with the marketplace approach is about really controlling the whole process end to end, and now you've got good enough partners out there where you can do that, and you can API into them, and you can really control the whole end to end process. So I think that model could definitely work, but you have to take on a period of funding customers before you've got a big enough base to then go and get those good deals and be interesting to some of those partners. So there is still a period of time you have to fund that, and that's fine as long as people are aware of that strategy.
Of course, a lot of neobanks are working toward just this long term, creating a fee-generating marketplace to subsidize free transaction banking. The question is how long it takes and how much it costs to build the customer base. As you say, you probably need a critical mass to entice third-party providers onto a fee-based platform. As a customer, I can't wait till we see those platforms reach maturity, but it feels like we're still a little ways off. We may need to reconnect for a round 2 in a year or so to see where we've gotten. Virraj, what's the best place for people to find out more about Pockit and connect with you directly?
Sure. So we're obviously online and in the App Store. So customers can either search Pockit, Pockit, in the App Store, or go to pockit.com. And I'm on LinkedIn, and my email address is virraj@pockit.com. So feel free to email me.
Virraj Jatania, thanks so much for joining us today.
Thank you very much for having me. Really enjoyed it. Thanks.
Thanks for tuning into Rebank. If you like today's show, reach out. Follow us on Twitter at Rebank Podcast and join the conversation. For more on banking, fintech, and the future, check out our regular content at www.bankingthefuture.com.